Hello everyone. So I'm here to explain you about discounted cash flow model, and I'll be using free cash flow for that. And before no starting this concept, let me take you to the live market window, and then that we can understand why we are using this particular model, right? So let me just share my screen. So here you can see that it is a live portal, and here we can see that HDFC Bank is available at 1,549, and SBI is available at 764, and UPL, Aditya Birla. So many no list of shares you can see that at trading at prices, right? It is very easy to buy and sell, right? It is to just simply buy and sell, or you can open any account, any demat account, you can easily buy and sell. But the question is, you are buying this particular share from any of the portal you can buy, but you are buying at HDFC Bank at 1548 or 1549 or 1550. Is the right price for this share to buy or not? Since the market price that you can see on the screen is a market value, and it is totally based on the now trading which is going on, all the demand and supply, the number of buyers are taking part in buying and selling. And if the buyers are more, the share price go up. If the sellers are more, the price goes down. The simple demand supply phenomena, we know the simple economic phenomena, right? So what is the correct price of the share to buy? That is the question number one. And if is the correct price, I mean, whether should I buy this particular share at no, if I talk about HDFC Bank, can I buy this particular share at 1,550, 1,550 is the correct price or not? To buy the SBI Bank is 764 or 765 is the correct price or not? So there is one important method in valuation called DCF method, discounted cash flow method. This discounted cash flow method will tell you about the price, at which the share should be buy or share. No, the people should buy the share or not. Now, uh, using various assumptions and the growth rate, we'll try to find out that what should be the exact price of the share that the investor should buy, right? So let us just begin the discounted cash flow model. So discounted cash flow model is, so we'll be understanding the discounted cash flow model. I'll be explaining what exactly it is, and why we are using free cash flow for that. That also I will be telling you. And then I'll be sharing you a company financials, and then we'll be knowing that how we can go for it, and how we can understand that whether the share is overpriced or underpriced, and whether we should buy no particular share on a price where it is available or not, right? So let us just start what exactly DCF model is. So when we talk about the discounted cash flow model, right, it is a valuation model, it is a valuation method, the financial model that determines when an investment is worthwhile based on the future cash flows, right? So we are talking about the investment in equity. We can use this particular method also when we are doing the project financing, when we are doing some method, some expenditure of capital nature. We know the capital nature method, capital nature expenditure are those expenditure which are irreversible. Once you have taken the decision, you cannot step back. So a lot of analysis that you should do before taking that such decision. So a DCF model is based on the idea that the company's value is determined by how well the company can generate cash flow for its investors in the future, right? So this particular method is basically explaining, basically analyze the things on the basis of the future cash flow, right? So without future cash flow we are not supposed to do that. And it is a discounted cash flow valuation, right, which is basically used to determine if an investment is worthwhile in a long run or not. For example, we have seen the one example right now, so going to the live market portal, that whether the investor should buy this particular share on a price which is available or not. Second example, we can see that which is commonly used in investment banking, that a DCF valuation is used to determine if the potential merger and acquisition is worth it or not. And also DCF valuation is used in a real estate or private equity right? Where the decisions are long term and lump sum. Outside of the corporate finance, the DCF valuation can help the business owner make a budget decision and determine their own projected value. A core principle of this particular model, a core principle of this particular model is that a rupee today has a different value the rupee tomorrow, and the principle that we call it time value of money. So we have to understand the time value of money concept before we jump to the DCF model. And it is this particular this particular concept, that is time value of money, is basically the foundation of DCF analysis, right? When we talk about the future cash flow, that is actually a projected future cash flows that must be discounted, right? So first, what we'll be doing, we will be projecting the cash flows that can be generated from a particular project and particular business or a particular investment. So whatever the future cash flow that is generated in future, and then we'll discounting it back in today's value by using present value concept or time value concept. And what we are doing to do this, we are trying to calculate the intrinsic value, that is the fair value of the investment, whether we should do it or not to do it. And then we'll be comparing with the current market value and finding out whether that investment is undervalued or overvalued or correctly priced or not, right? So this is what the base of this particular model. Now, coming on to the second important thing. Now, in this particular DCF model, that there are three different important things. One, I already told that it is the core principle behind this particular model is present value concept. And this present value concept, basically we need three important things, the three important concept that you should note down. Number one is the cash flow, that is the future cash flow, and it should be expected cash flow, or we can say projected cash flow, or assumption based cash flow. Second number is the total number of period. Obviously the period should be longer than 5 years or 10 years over the period of time, so that we can discount it. And the third important thing is the discounting rate, on the basis of which we can calculate the present value method, right? So this is what about the discounted cash flow model. Now what we have to do, we will understand why we are using cash flows, free cash flow in discounting cash flow model or valuation. Now what exactly is the free cash flow, let us just understand, and why we are using this free cash flow in our analysis, right, in DCF analysis or DCF valuation. The free cash flow is the excess operating cash flow, operating cash that a company generates after discounting, after accounting for a capital expenditure, such as buying land and building and equipment. So it is the excess operating cash. This particular cash is the cash which a shareholder can enjoy after accounting for all the capital expenditure. And this particular cash flow, this is that cash flow which is considered as a good mark for a healthy business, which is eventually depend on how much free cash flow that a business can generate. So a business generate a free more and more free cash, that the business is considered is very sound and healthy business. This free cash flow is the amount of the cash the company is left after paying all its expenses, including investment. Right. So it is a free cash. So when the company has a free cash flow, it indicates that the company is healthy. And the investors often look out for such companies whose share price are undervalued, but who have high and rising free cash flows, so that they can believe it over the period of time this particular disparity will disappear as the share price will soon increase. So thus the free cash flow helps us to know that if a company has generated earning in a year or not, right? Hence the investors, to assess the company's true financial health, look at the free cash flow beside the earning, right? So FCF or any company can be easily calculated through the cash flow statement. Let me take you to the free how we can calculate it. So I have taken this particular company called Amar Raja Battery Limited. and I have downloaded its annual report. And in this annual report, I am at page number 74. As you can see here, it is the cash flow from operating and cash flow from this is the cash flow from operating activities. It is already calculated, so we need not to see. So it is this is the cash which is generated. So let us see the net cash generated from this particular operating activity of Amar Raja Battery Limited is it is given here. It is 2787. I guess it is million. Yes, it is million. So let me tell you, if it is if the value is given in millions, we have to convert these values in terms of crores, because this is a standard practice in industry and financial modeling. So we will be converting that, right? So net cash from operating activities, here it is given is 2787.5 million, and this figure belongs to 2012 and 2013, sorry, 13 and 14. Yes, so these are the figure. I have taken 10-year data back. Reasons is very simple. I want to know that if I'm doing an analysis 10 years back, because I want to analyze that today the share price is overvalued or undervalued. So I'll be using that free cash flow. I'll be estimating, and then I'll be checking it out whether today's the ARBL shares, the Ramil Raja Battery Limited share, is overvalued or undervalued. That I will check. Okay. So net cash from operating activities, here you can see, and the formula is very simple to calculate the free cash flow, is that we have to deduct all the capital expenditure from cash flow from operating activities, so that we can have the free cash flow of that particular farm, right? So this is the net cash flow from operating activities. As you can see, here it is, and here is the expenditure of the capital expenditure we are talking about. So we will deduct this amount from this, so that we can get whether the company is having free cash flow or not, right? Now that I will do. So I have completed the entire DCF model valuation on a Excel sheet to make it more easy to understand, right? So this is the Excel sheet that I have prepared to uh, understand this model in a very easy way, right? So we will be doing this particular evaluation in total 8 steps, right? Step number one, first will be estimating the average free cash flow, okay? And then we will be identifying the growth rate, because I have already that this will be projected free cash flow, right? So in this particular discounted cash flow model, we need future cash flows which will be projected, which will be assumption based. So this growth rate I will be assuming, and I will lay down the no I will explain why I am using this growth rate, and why and how we can assume the growth rate as well, right? We will be talking about once we have calculated the free cash flow, then we will be identifying the growth rate, and then we'll be on the basis of that growth rate, assumed growth rate, we will be doing what, we will be calculating the future cash flow. So this future cash flow, which will be based on the assumption based growth rate, right? So and then after that we'll be calculating terminal value. I'll explain what exactly it is. This terminal value is basically the sum total of all future cash flow at a certain period in future. I'll explain it. Okay. So then after this, all future cash flows plus the future terminal value is calculated. What we'll be doing, we will be applying time value of money concept. We will be calculating the present value of all future cash flows using a particular discounting rate. I'll explain that how discounting rate can be assumed and what exactly it is. So we will be calculating net present value, and then we will be calculating, we will sum up all the present value of that future free cash flow plus terminal value, and then we'll be calculating the share price with a formula, simply taking all the present value of free cash flows, which is divided by the total number of outstanding shares. That will give us the price of that share, right? Coming on to this, since I already see that this particular model is assumption based model, this particular model is there are a lot of projected values is taken. So it is not we are not sure, after calculating, doing every analysis, we are not showing that we are on a right exactly this should be the value. So what we'll be doing on the safer side, we will be doing assuming a plus side and a minus side. I mean, whatever the value that we'll be calculating on a safer side, what we'll be doing, we'll be doing that intrinsic value band. So intrinsic value band is basically plus and minus 10% of the value that we are going to calculate. So then we will be calculating that, and then we will be calculating that, we'll be identifying that whether that particular share is overvalued and undervalued, which is exactly the objective of this particular model, right? So let us just begin. What we will be doing first, the very first step is that we have to calculate the free cash flow of a company. We have already taken that we have already taken the values of cash flow from operating activities of the same annual report that I have shown you previously. So this is the data 2013, 14, 15, 12, 13, 14. So 3 years data cash flow from operating activities I have taken, and I have deducted the capital expenditure of of the company, and so that I can calculate the free cash flow. First, I will be having that cash flow from operating activities. I will be deducting the capital expenditure. Why I am deducting? Because I want to know the free cash flow, right? Free cash flow the company have it in end, because this particular free cash flow, it is that cash which a shareholders money, which is considered as shareholders money, or it is the shareholders money. That is why we are taking that is free cash flow, right? So free cash flow, this is how it is calculated. Formula is there. It is cash flow from operating activities, and we have deducted capital expenditure, and then we have calculated the free cash flow, right? And once we have calculated the free cash flow by taking the exact figure from their cash flow statement, and we have calculated 3 years free cash flow, and then we have taken average. Now question is, why average? Why not single free cash flow of a particular year? So we can start with any of the year. Yes, of course we can start, but taking average is simply averaging out all the extreme cash flows if there in a particular year, because in any of the particular year the company may have more capital expenditure. In a particular year the company may not have any capital expenditure. That is why, to smoothing out, to averaging out, so we need a averaging out figure, so that sometimes the business is cyclical nature, right? Sometimes the cash is generated more, sometimes it is not that. So looking at this all scenario, uneven situation, uneven environment of the business, uneven no that basically lead the company to generate a different type of different value of cash flows. So that is why we are taking the average cash flows to start our analysis. So we have taken the average free cash flow, and now this average free cash flow will be the first value from which we have to start our model. So 140.4 crore is the average free cash flow of a company, and then what we are doing, we are increasing it for the next 10 years. Now increasing it for the next 10 years, we never know that what exactly the free cash flow for the next year, how we will do that. So we have to do this, second step, that is what we have to identify the growth rate. Now what exactly is this growth rate? Growth rate is that, first we have assumed a free cash flow of a particular year, and what will be the next year cash flow, that is what we have to assume. It entirely depends upon the growth rate, but whatever the growth rate of the company, whatever the growth rate of the everything will be there, which will be directly responding to the growth rate of the free cash flow. So this free cash flow will be growing as per the performance of a company, and now this performance can be judged, can be seen 2 3 ways, right? We can see the past performance of the company and calculate the growth rate, that how the company is growing, how the cash flow is growing. We can see the previous 5 years cash flow as well, that how the free cash flow is growing, so that we can calculate easily this is how the growth. Second is that we can assume the growth rate as per the industry practices, right? Now assumption is a very tricky thing, right? And whenever we are assuming anything, we have to we have to be very conservative, right? We have to apply a very conservative approach in that. We cannot exaggerate the figure, right? So a conservative approach says that a company can grow that 18% or 12% or 10% or 15% or 10%, whatever figure is that. But a company which is growing company, right? So we can go for assuming the figure like 18% and 10%, right? Why I'm taking two-step growth rate, that I will explain. Two-step growth rate, that over the period of time the growth rate will change. For example, the today's growth rate of HDFC Bank Limited is 17% or 18%, and after 10 years, after 5 years or 6 years, because it is an assumption, right? It will stabilize or it may increase at a diminishing rate as well. So whenever, and since I have already said that I will be very conservative while I am assuming any growth rate. So this company, that Amar Raja Battery Limited company, is basically a developing company. It is a growing company, right? So it is a growing company. So that is why I am taking 18% and 10% growth rate to be more conservative. If the company is established one, if the company is already established one and is a market leader, right? So we have to be more conservative while assuming the growth rate, that is so in that case I'll be taking 15% and 10%. But it is ARBL, I'll be taking 18% for the 5 years. It means the cash flow, free cash flow, will be increased every year by 18%, and then after 5 years it will be increased by 10%. This is assumption. It is a pure assumption, right? And this can be 2015, this can be 1510. It entirely depends of how the situation you see as an analyst, right? So I have assumed that 18%. So now we come to this particular table. As you can see here, I have shown the calculation how the growth rate. So I will be starting with 140. So 140, and when I'll be increasing it by 18%, so I'll be simply multiplying by 1.18, so that it will increase to 18%. It is a simple Excel formula I have applied to this particular table, and I have calculated the next 5 year growth rate of future free cash flow of Amar Raja Battery Limited. So when I increase 140 by 18%, I will get 165.6, which is the figure exactly you can see here. One. Okay, when I increase it, this particular figure again by 18%, so what I will do, this 165.6 will be multiplied by 1.18, so that I will be having the next year free cash flow that is around 195.4. So this is what I have already calculated. So this is the first year free cash flow projected. This is the second year free cash flow projected. So first year, second year, third year, fourth year, fifth year. And now the rate, the growth rate is changed. The growth rate is changed to 10%. Now 10%, here you can see it is 10%, right? So 353, it will be 353, and then again it by 10%, and then again by 10%. So this is the free cash flow for the next 10 years of Amar Raja Battery Limited, and it is future projected assumption based free cash flow, right? This is not actual, this is assumption based future free cash flow. Now what happened after 10 years? 10 years free future cash flows I have already calculated. It means this will be the cash flow that shareholders can enjoy. So I'll be considering it is a cash inflow to the cash shareholder, but actually it is not cash inflow to the shareholders. It will not go to their pocket, but this is shareholders fund which is there with the company, the shareholders fund, right? Shareholders actually enjoy this free cash flow because we have deducted all the expenses, even we have deducted all capital expenditure as well, right? So this is pure free cash flow that a shareholders can enjoy, and this is projected future free cash flow that shareholders can enjoy over the period of 10 years. Now what happened at the after 10 years? The company will be there, yes, of course, according to the accounting principle, going concern principle, the company exists forever. So what happened after 10 years? The 10th year after, because we can assume up to a certain limit, right? We cannot assume it for next 20 years to 50 years or 100 years, right? Otherwise this will be simply a calculation, and calculation, only a calculation. So we have taken 10 years period of time, and what happened after 10 years period of time? We will stop our assumption here, and we will be calculating all the future cash flow, all the future cash flow, the sum of all the free future cash flow of on 10th year, on 10th year, and that 10th year is known as terminal year. and we will be assuming a particular growth rate also beyond 10th year of a company, that we call terminal growth rate. And whatever the value, that is the sum total of all free future cash flow after 10th year, is known as terminal value. Okay, so this terminal value that we will be calculating here. So as you can see in this particular table, I have calculated the terminal value. The formula is very simple: the free cash flow into 1 plus terminal growth rate. That terminal growth rate is simply that growth rate that is beyond 10th year, right? And which is divided by discounting rate. Discounting rate, I'll come to this point. Discounting rate minus terminal growth rate, right? So this is the formula to calculate terminal value. This FCF is the 10th year FCS, right? In terminal value, we will be taking this particular free cash flow is the 10th year. It means we will be using this value 570.1. This value we will be using while calculating terminal value, right? Now we have calculated the future cash flow. We will be calculating the terminal value. Now terminal value formula is there. Let me just show you the formula how I have done it. Let me click on that. This is the terminal value. Now on formula bar, as you can see, uh yes, you can see the formula bar here. This formula I have applied. Here it is. So I have taken 10th year free cash flow. As you can see, 517.12. This is the 10th year free cash flow. I will be using that because this terminal value is the sum total of all future free cash flow that the shareholders can enjoy after 10th year. So it is a sum total of all the values, right? So formula is very easy. I'll be using the growth rate. I'll be very conservative while assuming growth rate. So I'll be taking the terminal growth rate is just 3.5%. Normally it should be less than 5%. You can take it 2.5, you can take it 4, you can take it 3, but it should be less than 5. So I'll be using 3.5. That is the terminal growth rate. Terminal growth rate is that growth rate that will be the growth rate of future cash flows after 10th year. Because first 5 years I have taken 18%. Second 5 years I have taken, I mean from 6th year to 10th year I have taken 10%, and then I'll be more conservative because I will be assuming a growth rate that is up to infinity, right? So up to infinity I will be very conservative. So 3.5% is bare minimum growth rate that the company is, that I can easily get. That is why I'm taking this particular figure. 9% is the discounting rate. Now, coming on to this discounting rate point, this is very important. The discounting rate is that rate which actually calculate the present value of future cash flow. Right now, this is considered as no. There are so many things we can assume as a discounted, but what we can do, there are two things. One is we can calculate the weighted average cost of capital, that you can consider, at no the company's discounting cash flow, but that will lead me to take you to the another calculation that will take a lot of time. So that is the one way through which we can calculate it. The other way is simply an assumption, that is an industry based or a practically possible way of discounting rate. That's normally 8%, 9%, and 10%. That's it. So 8 to 10% discounting rate that I'll be using. I am using here 9% discounting rate, which is totally an assumption based. So I am using discounting rate at 9%. If you don't want to take the assumption based discounting rate, you can calculate the WACC, that is weighted average cost of capital, and you can take exactly that and you can discount it, right? So this is the terminal value. Now I calculated the terminal value, that is 9,731.26 crores. Now, this is what, this is terminal value of Amar Raja Better Limited. It means this 9,731.26 crore is the sum total of all the future cash flows beyond 10 years. So this is the terminal value of it. But that is the value that is there after 10th year. Okay. Now this is what I have calculated, all future cash flows that the shareholders enjoy in a company, right? First 10 years free cash flow, on the basis of free cash flow, and beyond 10 years all sum of all future cash flows I calculated as terminal value, which is coming around 9,731.26, right? Using this particular formula, right? What I will be doing now, I will be calculating the present value using the discounting rate, because this is free future cash flow, projected future cash flow of a company, right? So this is the future cash flow I have already calculated, applying a simple growth rate formula. Now what I will be doing, I will be using the present value concept and discounted method, so that I can calculate the exact present value of future cash flows, right? So it is very simple. If I'm is looking at this today, it is 1 year later, it is 2 year later, it is 3 year later. So whatever the value, whatever the cash flows I'm receiving here and here, what I'm doing, I am coming this to this particular level, that is today's value, right? So this is simply taking back all the figures in today's present value, right? This is the concept. Now, if you calculate the present value can be simply calculated by a formula present value, when we have to have the future value, because obviously present value is what, it is the discounted value of future cash flows. So we need to have a future cash flows or future value, and then we'll be applying a simple formula of 1 upon 1 plus r to the power n. This is the formula to calculate present value. Okay, where r is the discounting rate, n is the number of period. Suppose if I want to calculate the present value that of amount that I'm going to receive after 1 year, so this n is equal to 1, discounting rate whatever we assume, 8%, 9%, 10%, or this is WACC, right? WACC is simply weighted average cost of capital, right? And this is future value, and right. Now we can calculate using this particular method. What we can calculate the present value. Let me just take you. So if I have to calculate the present value of 165.6 crore, that is the free cash flow, projected free cash flow for the first year. What I will be doing, I will be dividing it by 1 plus growth rate is simply I'll be taking 0.099%, and since it is for 1 year, I'll be using here n is equal to 1. I will be getting 151.9. Okay, this is simply what, 151.19 is the present value of 165.6. That is the cash flow that I will be receiving as a shareholder. It is a free cash flow I'll be receiving after 1 year. So this is the present value of first year free cash flow. And here, so the same formula I've applied for the next 10 years. So I'll be calculating the present value. Here you can see the present value is converted, the future value is converted into present value. 1968 is the total free present value of projected future free cash flow. Now, I have one more figure that is to be received, that is our shareholders can enjoy after 10 years. That is terminal value. Yes or no? Yes, so terminal value I have already calculated, that is 9731.6. So the same formula I will be applying, and I'll be calculating or taking the terminal value back in today's term. That is calculating the present value of terminal value. This is where I have done. I've applied the formula and I got that the present value of terminal value is 4110.7 crores. Okay, now I have two present values. Number one, the present value of all the series of free cash flows that I have projected over the 10-year period of time. And second is the present value of terminal value that I have calculated here, right? So what I am doing, I will be merging these two present value, so that I can have the total present value of future free cash flows of a company, Amar Raja Battery Limited. Okay, now I have added this 196 set and this 4110.7. Okay, so this is the sum total of all free cash flow. This is the present value of terminal value. What I'll be doing, I'll be adding these two values so that I can calculate the total present value. Now this is the total present value. Basically here's our discounting cash flow model ends, but yes, let me finish this particular model to the end, right? So this is the total present value of the free cash flow of Amar Raja Battery Limited. Now there is one thing which is left, right? That also we need to consider, right? That if the company is having cash in hand and cash at bank, or if the company is having some debt or not. So we have to calculate the net debt for that, right? If the company is having net debt, we can assume that this particular amount also can we can deduct from the free cash flow, because this debt is also an important liability the company have. So what we will be doing, we will looking at once that whether the company is having debt or not. We will be calculating the debt. How we can calculate? It is very simple. We can calculate it from the financial statement. We can have, so from the financial year 14 balance sheet, we have taken a particular figure that this current year debt is 75.94, and the total cash balance and the cash the company have is 294.5 crore. That is more than the debt the company have. So the figure is coming 218.6. Now this 218.6 is the excess cash that we can have from the company 2014. The company, after paying net debt, also the company is having some cash in hand, right? So what we can do, so we have calculated that the company's today's present value of all future cash flow is 6078.8, right? Now and what we found that the company have some excess cash in 2014, that is 218.6 crores. So we'll be adding up, right? Because this is also we'll consider in free cash flow, and that's free cash flow that shareholders can enjoy, right? So this is when we add the no this particular figure, that is 6078, that is the present value of all future cash flows, and this 218.6. So we'll be having 6297.43 crores as a free cash flow that we have total. Now what would be doing? Wait, what we'll be doing, what we need to calculate is the share price. Remember that we have to calculate what is the objective of the particular free cash flow model, is to know that whether the share is overvalued or undervalued, whether should I buy that particular share. So now from this particular free cash flow, we have to calculate the share price of a company. How we can calculate it is simply we will be using the total number of outstanding share the company have. That can easily be find it out through financial statement. We can see it directly from the balance sheet or P&L. We can easily see that this information is given in annual report as well, that the total number of outstanding share. So I have taken the outstanding share from the financial statement of Amar Raja Battery Limited, and I found it is 1.7. Just remove. I found that the total number of share outstanding is share is 17.081 crore, right? This is the total number of outstanding share the company have. You can see this particular figure here in the formula bar. You can see. Okay, so I have divided the total cash flow that I have calculated by a total number of outstanding share, that is 17.08, and I have calculated the price is 369 per share. Now this is known as intrinsic value of intrinsic value of Amar Raja Battery Limited. Intrinsic value is the fair price that investors should pay in order to buy the share at a particular period of time. Now, this is the assumption based, calculation based. So many assumptions we have seen. We have taken the assumption of growth rate. We have taken the assumption of discounting rate. Okay, so these are the assumptions that we have taken, and we on the basis of this assumption based calculation, we found that the Amar Raja Battery Limited share must be at 369 rupees, right? Now, what we will doing, we will be checking out the share of Amar Raja Battery Limited on NSE's website, right? And let me just take you to the exact price of Amar Raja Battery Limited today. Is I have that. Just here it is. So this is the figure, Amar Raja Battery Limited. This figure is taken from National Stock Exchange, and I found that Amar Raja Battery Limited share is 726 0.708. What I found, the intrinsic value of this particular share is 369 rupees, and it is now trading at 726. What does it mean? That it is highly overvalued as per my calculation, as per my assumption. And if it is overvalued, it means what? It is overvalued. It simply means that we should not buy it, right? Anytime the market fluctuate and the share may go down, because this is overvalued. Overvaluation comes from the buying pressure of the market, right? There are a lot of buyers when enter into a particular share, and this buying pressure and this demands takes the value upside. And the opposite is also true. The undervalued is that if I found that this particular share, let us suppose, just for an example, if this shares is available at 300 rupees, suppose this is the market value. This is not exactly the market value, but I am supposing it. Suppose the market value is 300 rupees, and I found it is 369. So it means that this particular share is undervalued. Undervalued shares. This is the right opportunity that I can enter into the investment of this particular company, right? Because it have the chance to grow in future, right? That is the overvaluation and undervaluation. Here I can decide as an investor whether to invest in a particular share or not. This is how overvaluation and undervaluation can be handled. So this is the outcome of free cash flow model, and that's it from my side. Thank you so much.